This video covers Ryohin Keikaku's full-year financial results for FY 2025 for the period from September 2024 to August 2025. Ryohin Keikaku owns and operates Muji, a global retail brand known for its minimalist, no-brand products with stores worldwide. Ryohin Keikaku designs, manufactures, and sells a wide range of household goods, clothing, and food items, focusing on simplicity, functionality, and sustainability. FY25 highlights and outlook. FY25 was much stronger than expected, mainly due to the success of its enhanced product development and promotional strategies. Operating revenue and all profit levels reached record highs, marking a historic year for the company. The results were even higher than the revised plan announced in July, driven by strong overseas sales, especially in mainland China, Europe, and North America. Focus on skincare as a global core product category and the steady expansion beyond Japan played a major role in this success. Looking ahead, Ryohin Keikaku plans to achieve further growth in both revenue and profit for FY26, aiming for record highs for the third consecutive year. Consolidated full-year financial results for FY25. In FY25, revenue rose by 18.6% and operating profit increased by 31.5%, with both reaching record highs, partly supported by favorable foreign exchange effects. The operating gross profit margin improved by approximately 0.5 percentage points year-on-year to 51.4%, driven by lower product costs through enhanced in-house production management and reduced discounting in overseas markets. The SG&A expense ratio also improved by about 0.4 percentage points to 41.9%, mainly due to sales growth in Japan. Net income increased by 22.3%, benefiting from lower tax expenses related to the reorganization of the European business. In FY25, all segments recorded year-on-year growth in both revenue and profit. In Japan, like-for-like store EC sales rose 13.5% year-on-year, with all categories seeing double-digit growth. Operating profit margin also improved due to better cost efficiency. Health and beauty and houseware performed especially well, increasing their sales share compared to 2 years ago. Customer growth was supported by new and returning dormant users, along with more frequent store visits. In East Asia, like-for-like store EC sales increased by 14.2% year-on-year, driving strong growth in both revenue and profit. Operating profit margin improved due to a better cost of goods sold ratio, reflecting more efficient production and lower discounting. In mainland China, sales grew, with profit also rising thanks to improved cost structure and reduced discounting. In Taiwan, sales increased, with revenue and profit up despite sluggish apparel sales, supported by improved gross margins. In South Korea, sales rose driven by strong sales in household goods and food. Local profit grew, though yen-based profit was slightly impacted by FX. In Hong Kong, sales increased, with revenue and profit recovering in the second half due to price revisions and store refurbishments. In Southeast Asia and Oceania, like-for-like stores EC sales grew 28% year-on-year, driving revenue and profit increases, partly supported by favorable foreign exchange. Operating profit margin declined slightly due to upfront costs for new stores and increased staffing. Sales improved across the region with expanded product lines, including skincare products popular in Japan. In Thailand, sales fell short of last year but began recovering in Q4. In Singapore, sales rose after price reductions to clear inventory. In Malaysia and Vietnam, new store openings supported strong sales growth. In Europe and North America, like-for-like store EC sales grew by over 7.9% year-on-year, driving higher revenue and profit. Operating profit margin improved, aided by favorable foreign exchange. In Europe, revenue and profit rose with double-digit sales growth, continued closure of unprofitable stores, and effective structural reforms. EC sales grew strongly due to expanded delivery areas and improved product lineup. In North America, store sales also grew, supported by strong apparel sales and prior store closures in Canada, boosting profitability. As of the end of August 2025, the total number of stores reached 1,412, a net increase of 107 stores compared with the previous year. In Japan, the number of stores increased by 60 to 683, with new locations mainly in suburban areas. The world's largest Muji store at Aeon Mall Kashihara, which opened in March, has been performing well. Overseas, The number of stores increased by 47 to 729, mainly in East Asia and Southeast Asia. In mainland China, 24 new stores were added through a scrap-and-build strategy, focusing on larger, more profitable locations while closing underperforming stores. In Southeast Asia, 19 new stores were opened, mainly in Malaysia and Vietnam, often in shopping malls. In Europe and North America, the closure of unprofitable stores was completed, and new store openings are planned to resume in FY26. For FY26, both revenue and profit are expected to rise, marking record highs for the third consecutive year. Operating revenue is projected to grow by about 9.6%, supported by higher same-store sales and continued new store openings. The gross profit margin is expected to improve as cost efficiency strengthens through better in-house production and reduced discounting, even though the positive effect of foreign exchange will fade. The SG&A expense ratio will slightly increase due to higher IT-related expenses. Operating profit is forecast to grow 7%, and while the overall operating margin will appear lower, it will show real improvement when excluding foreign exchange effects. Net income is expected to remain solid even without the one-time tax benefits from the previous year's European reorganization. FY26 outlook is promising, as Ryohin Keikaku projects record-breaking earnings. Ryohin Keikaku plans to raise dividends for 2 consecutive years in FY25 and FY26. In FY25, the annual dividend is expected to increase to 50 yen, a 10 yen increase from the previous year. A 2-for-1 stock split was carried out in September, aimed at enhancing liquidity and accessibility for investors. In FY26, the dividend per share is projected to increase to 28 yen, equivalent to 56 yen on a pre-split basis. Under the business strategy, Ryohin Keikaku aims to achieve operating revenue of 1 trillion yen and operating profit of 100 billion yen by FY28. This would result in an operating profit margin of 10% and more. The plan reflects the company's goal to continue expanding globally while maintaining solid profitability through improved cost efficiency and product competitiveness. Stock price. This is the Japanese yen base chart for the last 1 year. The Japanese yen stock price is 288 yen as of October 10, and the US dollar stock price is $9.27 as of October 10. The stock price had been declining recently, following a year-on-year drop in September sales, the first decline in a while. The current PBR is 4.46 and the PER is 27.9 with a dividend yield of 1.0%. Compared to the past few years, the PBR, PER, and dividend yield suggest that the current stock price is still relatively high. The stock price has risen sharply this year and remains at a relatively high level compared to the past few years. However, this also reflects shareholders' expectations for future growth. Conclusion. FY25 marked a strong year for Ryohin Keikaku, with record-high revenue and profit supported by solid performance across all regions. Strategic product focus, especially in skincare, and disciplined cost management contributed to the company's success. Looking ahead, while growth is expected to continue in FY26, the pace may moderate. Although the stock price had declined due to the sales slowdown in September, it's encouraging to see that Ryohin Keikaku is still forecasting revenue and profit growth for FY26.